Welcome to this session for CMA final students. This is your paper number 14 titled as Strategic Financial Management. And here we are going to revise one of your most important chapters titled as Investment Portfolio Management. Let me tell you something about this chapter. This chapter is more formula driven and comparatively less logic driven. When we revise foreign exchange risk management, you must observe that it is more logic driven. There are no fixed steps to solve questions under foreign exchange risk management chapter, but there are fixed formulas available to solve the questions under investment portfolio management chapter. So you will have to kind of mug up or cram a lot of number of formulas for the purpose of this chapter. So be prepared for that. Even after watching this video, if you have some doubts, you can connect to me on WhatsApp at 9893040600. I'm your friend and mentor for the session, Arun Mahajan, by qualification and BCom, DSA, chartered accountant, a chartered financial analyst from USA, as well as a practicing registered valuer. So here we go with this chapter titled as Investment Portfolio Management. Let me remind you for one thing, these are revision videos. So do not expect 100% coverage. Do not expect that a whole lot of questions will be solved during the session. What we are trying to do is to quickly revise all important concepts and to solve a few questions for greater clarity of those concepts. See, before I teach you that what is portfolio management or what is investment portfolio management, first question is, why should I make investments at all? See, I am an individual, I have a job role, I do earn salary. So when I receive salary, I should spend money for my house, for my clothing, for my food, for my entertainment, for education, etc. Why should I save some of my income? Why should I invest this money? And the reason here is very simple. There is a mismatch between your earning cycle and your spending cycle. So usually earning cycle of an individual starts from the age of 25 years and usually it ends at the age of 60 years. So the total earning cycle or the earning period, earning duration is roughly 35 years. And suppose your age is 80 years. So you do spend money for the entire time span of 80 years. While you do earn money only for 35 years. You earn money for 35 years. You spend money for 80 years. So there is a mismatch between your income cycle and your expenses cycle. It means whatever you earn, you should not spend the entire money immediately. A part of your income should be saved, and this saving you cannot keep it idle. Why do you save money? So that in future when you will have lower income or when you will have no income, at that time you will be able to spend that money. But should I keep my saving idle? Should I construct a basement in my house and with a secret staircase and door, and there I will put a tijori or a locker room, better I say, and I'll keep all my savings over there? And my answer is no. You cannot keep your saving idle. Not only you should work for money, but your money should also work for you. This is very important. It should not happen that you keep on working for money for your entire life Your money should also work for you, and that will be possible only if you make investment of this money. Even during your earning cycle, your spending does not remain constant. So suppose for education of your children or for marriage of your children, a huge lump sum amount will be required in some of the years of your earning cycle. So when you have huge expenses in a particular year, you will not have huge income in that particular year. Income will be more or less equally spread throughout your earning cycle. While some of the expenses will be clustered, will be accumulated. And for that purpose also, you need to make saving and you need to invest that saving so that your money can at least fight with the inflation, and in fact, money can earn more money for you. Now, there is a $1 million question: where to invest this money? So, traditionally, there is one very popular investment, one very lovable investment for Indians, and that is gold. One of the ways to invest your money is to buy gold, silver, platinum, diamond. Other way could be you can buy real estate like land, urban plots, or some flat or some bungalow or some commercial property. You put it on rent and have the rent income, and also when the price appreciate later you can sell it out. So people make investment in bullions like gold, silver, platinum, maybe in stones like diamonds, maybe in real estate, that is land building, maybe people also make investment in artwork like paintings and sculptures. But these are, quite a few people are there who invest in artwork. The most and huge amount of investment actually happens in securities like equity shares, debentures, preference shares, shares with differential voting right, and various types of bonds, etc. So one of the most prominent investment is investment in securities like shares and debentures. And this whole chapter of investment portfolio management, we will not be discussing how to make investment in gold or silver or land or building or artwork. Rather than we will be discussing how to make investment in securities. Okay, first of all, why should I save money? Why should I invest money? Now the next question is, where should I invest money? And the next question is, okay, I have got various investment opportunities and I can invest some money in all of those securities. But there is one more question, and the question is like this: what are my investment objectives? When I invest money, what do I actually want to achieve? See, the most important, most prominent objective of any investment is actually return. You invested 100 rupees, you want to make it double, say to 200 rupees in 5 to 10 years time period, or at least you want a return of 5 to 10% or 10 to 15% per annum. The whole purpose of this investment exercise is to earn return on your investment as high as possible. So the primary task as an investment manager should also be maximization of return on your investments. But at the same time, you need to keep in mind risk factor also. Usually, if you want to maximize your return, you make investment in risky securities. Suppose you are okay with a 5%, 6% per annum return, you can simply make FD in State Bank of India, full stop. No, sir, I want to have a return of 10% or 15%. Okay, in that case, you will have to make investment in some risky securities like equity shares of top class companies or equity shares of mid cap companies or equity shares of small companies or the small cap companies. So to increase your return, usually you make risky investments, but that should not happen. investment management should happen in such a manner that you should try to increase your return, and at the same time you should try to reduce your risk on investment. Then one more objective should be kept in mind, that is liquidity or nearness to cash. It simply means that whenever you want your money back, you must be able to quickly convert your security into cash. Like if you make investment in real estate, some rural agriculture land far away from your city, then it is kind of illiquid investment, because whenever you want your money in cash, it will be difficult to sell out this property. But if you buy equity shares of a very popular company, it will be very liquid investment, and within minutes, within seconds, you can sell out the securities, and within 2-3 days time period, you will be able to realize cash. So, as a manager of my investment, my objectives are to maximize return, to minimize risk, and to optimize liquidity. Maximize return, minimize risk, and to optimize liquidity are my objectives. See, usually people don't make investment of their entire money in a single security. Rather than they do make investment in a bunch of, in a bouquet of securities, 5, 10, 20 types of equity shares, some types of bonds, some fixed deposits, some gold, some property. So they make investment in many securities. The bunch of these investments is actually named as portfolio, and that's why this chapter is titled as investment portfolio management. That's why this chapter is titled as investment. It's not investment management, it's investment portfolio management. So you should try to manage your portfolio in such a manner which maximizes return, which minimizes risk, and which gives you appropriate liquidity, or I can say which can optimize your liquidity, nearness to cash. Now the question arises, how do I achieve these objectives of investment? And the answer is here. If you want to make investment of your savings, you can make it in one of the following two methods. One is the direct investment. You yourself go to the share market, get yourself registered with a share broker, and start identifying good equity shares, and make a phone call to broker and ask him to buy the shares, to sell the shares. Do it yourself, whatever you want to buy. Roughly 6,000 companies are listed in India. Do whichever company you want to buy, and invest in whichever company you want to make investment, and sell out whenever you want to sell it out. But sir, I don't understand this investment management. I'm a doctor, I'm an engineer, I'm MBA marketing person, I'm a housewife, I'm a businessman. I don't understand this capital market, especially this share market a lot. In that case, you can make indirect investment. That is, you give your money to some professional managers like mutual funds, and in turn, they will invest your money in good securities. Okay, so when you are making a direct investment, you can either make it in equity shares of the company or in debentures of the company. If you're making indirect investment, you can do it through any of the mutual funds available in India. There are 40, 50 fund houses available in India, and each fund house has roughly launched 30 to 50 schemes. So there are, roughly 2,000 mutual fund schemes which are available. Like you have 6,000 equity shares which are listed and available for investment. And similarly, roughly there are 2,000 mutual fund schemes, and you can choose one of the best schemes and make investment of your money over there. So what did we study? It's like this. If you're making investment, either you can do it individually yourself, or you can opt for some collective investment scheme like the mutual fund, and a similar concept is exchange traded fund, or a different concept is hedge fund or any other pooled investment vehicles where many people invest money and then their money is managed by a single manager. If you're making a direct investment yourself, either you can make investment in equity shares of a company or you can make investment in debt securities of a company. And there is a separate chapter, like for mutual fund, we have a separate chapter. For debt securities, we have a separate chapter. Now, how to make investment in equity shares? I can classify it into two parts. Number one, regular investment. Every month, every quarter, every year, I'm making some investment. So, some regular investment theory, like Harry Markkovitz model, should be followed for the purpose of achieving your investment objectives. The other one is opportunity based investment. You know, in Hindi, there is a saying, "Mauka dekhkar chauka marna." That is acting according to the opportunity available. So you are making your regular investment, that's a different portfolio. But at the same time, you find some interesting investment opportunity in the market suddenly. That is some you bought some undervalued securities, or you can sell some overvalued securities. That's opportunity based investment. How to identify which of the securities are undervalued or overvalued? So capital asset pricing model can help us a lot on this matter. We will study capital asset pricing model as well as market model for the same. So now this is the time that out of this whole chart, we are going to explore the Harry Markkovitz model. That is, I am an individual investor. I want to make investment in equity shares. This is a regular investment which I keep on making from time to time. So the $1 million question here is, there are 6,000 listed equity shares available in India. Which share should I buy? Or should I buy even the unlisted shares? Question is, which share should I buy? Out of 6,000 listed shares, suppose I choose that I will buy 20, 30 shares. So which 20, 30? And once I decide which 20, 30, the next question will be in what proportion? How much should I invest in selected investment 1? How much should I invest in selected investment 2? And so on. So choosing the right security and assigning them the right proportion in my bunch of investment, in my portfolio of investment. These are the questions which will be answered by Harry Markkovitz model. I repeat, my dear friends, we are not talking about collective investment schemes like mutual fund. We are talking as an individual investor. We are not talking about debt. We are talking about equity. Again, we are not talking about some undervalued or overvalued securities and take advantage of it. Rather than we are making just a regular investment, and Harry Markkovitz model will actually help us to choose the right security and to choose the right proportion. So let's begin with this Harry Markkovitz model. You know, we will finally make a portfolio. What is portfolio? Bunch of investments. We will finally make a portfolio that is a bunch of investment, but we will take, step by step process. We will follow the step by step process. First, we will learn to evaluate a single security. There are three things to be evaluated: the risk, the return, and the liquidity. Liquidity is okay, but you need to focus on two primary things, that is the risk and the return. So we will learn how to calculate the return of a single security, how to calculate the risk of a single security, and how to choose a single security if many options are available. Then we will proceed further and learn to make a two securities portfolio. How to choose a best two securities portfolio. Then the next step may be three securities portfolio, four securities portfolio, and finally the N securities portfolio where we would like to invest our money. right? We are trying to answer the question, in which security should I make investment and how much money should I invest in that security out of my total investment budget. So here I go, single security. Ultimately, you select a security which has a higher return or which has lower risk or which has both higher return as well as lower risk. So I start with this single security, how to calculate return on a single security, and that too for a single period, single security and single period. This is also named as the holding period return, HPR. And this return is equal to D1 plus P1 upon P0 minus 1. What is R or RP? It is return for a single period or holding period return. What is D1? It is dividend for the first year. What is P1? Market price at the end of first year. What is P0? It is market price at year 0. Or better I say, it is market price at the beginning of the first year. So market price at the end of first year is in the numerator and market price at the beginning of the first year is in the denominator. And D1 is dividend for the first year. One simple question will make our concepts clear. Suppose there is a company named as Baker Limited and you purchased shares in this company on 1st of January at a price of $50 per share. This stock paid a dividend of $2 per share during the first year. And at the end of the year, this stock was sold for $45. You're required to calculate holding period return, that is the single period return for this company. Look, this is very simple. To calculate holding period return, I'll follow D1 plus P1 upon P0 minus 1. So D1 is $2, P1 is $45, P0 is $50. So, by investing $50 at the beginning of the year, you are getting $47 or your value becomes $47 at the end of the year. There is a loss. You invested 50 and now your value is 47. There is a loss of $3 on investment of 50. 3 on 50 is actually 6%. Right? Without this formula also, I can say my investment of 50 has came down to 45. So that's a 10% negative return. 50 has become 45. That's a loss of 5. That is a 10% negative return. But at the same time, I earned positive through dividend. I earned 2 on 50. Now 2 on 50 is 4%. So 10% downfall in price, 4% dividend income, net loss is 6%. Forget about the formula. You simply take appreciation in stock price and add dividend yield to it and you'll get the holding period return. Let's take some imaginary figures also. Suppose you invest 100 rupees in a stock today. At the end of first year, the market price appreciates to 120 rupees. And during the year, company pays a dividend of 10 rupees. So the numerator has become 130. 130 upon 100 is 1.30. 1.30 minus is 0.30. To show it in percentages, multiplied by 100, 0.30 into 100 is 30%. That's the formula. If you go by the simple logic, your 100 rupees has become 120 rupees. That's a 20% appreciation. Additionally, there is a 10% dividend yield. So what is your return? It's nothing but appreciation plus yield. What is your return? It's nothing but appreciation plus yield, right? But when I want to take a decision, I won't just check return for a single year. I would like to check the return for multiple years historically. I can't say last year, this year provided 30% return. So I presume that every year it will provide 30% return. Rather than considering just 1 year, I'll consider previous 5, 10, 20 years and take an average of those return then I can say, okay, on an average, this stock is providing a return of 18% per annum, something like that. How do I calculate average return? So look here, there are two ways. Either you are using the forecasted data or you are using the historical data. There may be two such situations, right? So return for a single period may be abnormally high or low. Therefore, it is better to calculate the average return. Average return may be calculated either using the historical data or using the forecasted data. If you are using the historical data, this part will go away. So if you are using historical data, it will look like this. Then in last 5 years, a company has provided a return of 10%, 15%, -6%, 2%, and 20%. Last 5 years, the return on the security looks like this. It looks like this. Okay. So this is the historical data. If you know, in statistics, there are three types of series. One is individual series, one is discrete series, and one is continuous series. So this looks like an individual series. Whenever you use historical data, actually it forms an individual series. But you say, no, it's not historical data, rather than it is the forecasted data. So I'm not looking into, past 5 years now. I'm looking into next 1 year only. I'm looking into next 1 year only. So what will be the price at the end of first year and what will be the dividend at the end of first year? I'm trying to forecast that. But when you forecast your price or dividend or return, you cannot forecast it with full accuracy. You cannot make a point estimate. What you can make is a range estimate. If I ask you, what was your score in CMA intermediate examination? So you won't say it was between, suppose you appeared in both the groups of CMA intermediate examination and you cleared it in first attempt, and I ask you, what was your score in CMA intermediate? You will say it was 55%, exact 55%, a point value you will give. You won't say my score was ranging between 50 and 60%. No, history is certain. So what is the date of independence of India? With certainty, you will say 15th of August 1947. There is no ambiguity. It is just a single point. But if I ask you to forecast that once you become a cost accountant and you go for a job interview and you got selected, what salary do you expect? You won't say I will receive 8,32,536 rupees and 49 paisa per annum. No, no, no. You will say, sir, I expect my first salary to be between 8 lakh and 10 lakh or 8 lakh and 12 lakh rupees. Something like that, right? So for future, making a point estimate is difficult. You make a range estimate. So suppose I use the same data. In future, in first year, either I will earn 10% or 15% or 20% or 2% or -6%, with respective probability of zero point 0.1, zero point 0.2, zero point 0.1, 0.3, and zero point 0.3. If you make a sum total of all probabilities, it will be definitely 1. Right? Now, this is not an individual series as per statistics. It is a discrete series. Yes, it's a discrete series where you have the value and the frequency. This probability is nothing but frequency. As far as continuous series is concerned, in SFM, we are not going to use it. If data is historical, it's an individual series. Use mean and standard deviation formulas accordingly. If data is forecasted, it will be a discrete series where the frequency will be in the form of probability. Here you need to use the discrete series formula for mean and standard deviation. Now, what are the statistical formulas? How does it look like? Look here. Now, if you want to calculate mean and standard deviation of an individual series, so x bar, which is the mean of individual series, is equal to summation of x divided by n, right? Rather than writing the formula in statistical terms, if I write it in financial terms, rather than saying X bar, I'll say RP, that is return on my portfolio. Currently, we are discussing a single security portfolio. Then we will move up to 2 securities, 3 securities, n securities. So X bar, instead of saying X bar, I am saying return on my portfolio, average return on my portfolio is equal to summation of returns, summation of Ri divided by n. Okay. But if I want to calculate average return using forecasted data, that will be a discrete series. And for discrete series, it is not summation of x upon n. It is summation of x, fx upon summation of f. Here f is actually the frequency. Here f is actually the frequency of any data. So you multiply x with frequency, then you make a sum total of frequency multiplied by x, and then you divide it by summation of frequency. Now here in portfolio management, frequency is nothing but probability. So if I replace f by p, the numerator will become summation of px. See the selected text. So on the screen, summation of fx will become summation of px. And in the denominator, summation of f will become summation of p. Summation of probability is always 1. So you need not to divide by 1. And that is how this formula can be simplified like x bar is equal to summation of px. That's it. In financial terms, Rp is equal to summation of Ri, that is return for ith forecast, multiplied by Pi, that is probability of ith forecast. This was about return of a single security. But let's talk about risk also. If you do not consider risk, you may eventually take a wrong decision. Keep in mind. You need to consider both return as well as risk. What is risk? Risk means uncertainty of the return. I forecasted some return, but it may or may not come true. Suppose you forecast that I'll score 70% marks in CMA final, both group exams. But maybe you get actually 75% marks, or maybe you get only 55% marks. So that may definitely happen with you. Risk means uncertainty of the outcome. Uncertainty may also be termed as fluctuation or dispersion. Now, dispersion is a statistical term. In statistics, there are various measures of dispersion, like the mean deviation, quartile deviation, range, and standard deviation. Standard deviation is considered to be most appropriate. Standard deviation is considered to be the most appropriate measure of fluctuation or volatility. What is risk? It's fluctuation, it's volatility, it's dispersion. And in statistics, there is a tool to measure that volatility, that dispersion, which is named as standard deviation. Now, the sign we use for standard deviation is called this sigma. See the highlighted text. Sigma. This is the sign. In this is also, people also name this also as sigma. but this is the capital sigma versus this is the small sigma. So capital sigma is the sign for summation, while small sigma is the sign for standard deviation. Don't get confused when I say sigma. This capital sign, this one. Just a minute. I'm sorry. Wait a minute. When I say summation, I mean this. I don't call it sigma. When I say summation, I mean this. I don't call it sigma. Don't get confused. And when I say standard deviation, I mean this. This is the sign for standard deviation. This is your standard deviation. And this one is your summation, right? So don't get confused between summation and standard deviation. Okay. Okay. Calculation of standard deviation with historical data. If you're using historical data, it means it is an individual series. And for individual series, there are two ways to calculate standard deviation. One is with mean and one is without mean. If you calculate standard deviation with mean, it is sigma is equal to summation of x minus x bar square divided by n under root. So first of all, you take x. Suppose 5 years historical data is there, 10, 15, minus 6, 2, 20. You take each individual x, then you calculate x bar, then you deduct x bar from each individual x, make it a square. Why do you make it a square? So that if it is positive, it remains positive, and if it is negative, it still becomes positive. That's the purpose of making square, to nullify the effect of plus and minus sign. Negative square is also positive and positive square is also positive. Then you make a summation of these squared items. After making a summation, calculate an average, so divided by n. After dividing by n, then you realize, oh my god, I have divided by n, but I have squared it. So to compensate that square, I underroot it. See, what is standard deviation? This is nothing but mean of fluctuation. Mean of the data is x bar, but mean of the fluctuations, average fluctuation, is the standard deviation. I repeat, mean of the data itself is x bar, but mean of fluctuation is actually the standard deviation. Sir, but I don't want to calculate standard deviation using x bar. That is, I want to calculate standard deviation without mean. Sometimes, the mean x bar may be a number 12.32%. If you deduct this odd number, then a lot of odd number calculations will be involved and you'll get tired of these calculations. So if mean is not a round figure, mean is a decimal point number, then rather than using the first formula, it is advisable to use this second formula, which is calculation of standard deviation without mean, summation of x squares divided by n minus summation of x upon n whole square. So the beautiful thing here is you won't have to use x bar and still you can calculate standard deviation. No, sir, I'm not using historical data. Rather than I'm using forecasted data, then it's not an individual series. Then it is a discrete series. And for discrete series, you'll have to use the frequency formula. Don't do x minus x bar square. Simultaneously multiply it by f and then make a sum total, divide by summation of f. If you want to do it without mean, again put f everywhere. Summation of fx square upon summation of f minus summation of fx upon summation of f raised to the power n. But you know that you can simply replace this frequency by probability. You can replace this frequency by probability. So summation of p will be 1. you should not divide by 1. There is no need to divide by 1. The formula will be summation of p into x minus x bar square, and without mean it will be summation of px square minus summation of px whole square under root. So these are too many formulas, but there is no solution to this problem. You need to memorize these formulas. And best way to memorize a formula is to practice few questions based on that. As soon as you practice questions based on that formula will fit into your memory. Okay, let's do one question on this. So the question looks like this. Mr. Ashok Jain, a share broker, seeks your advice on risk and return of share of Bajaj Auto Limited. Okay. And Tesco. You want to calculate return, you want to calculate risk for Bajaj Auto as well as Tesco. From the website of Economic Times, you gather the following information about return of the two companies. So year 99, 2000, 2001 and 2002. It means these are historical return. Bajaj Auto provided a return of 25 minus 5, 10 and 15% per annum, while Tisco provided a return of 14%, 8.5%, 5.5% and 17%. And both the companies have provided volatile return. That means the risk is always there. Advise which share should be purchased. So if I have to take decision, choose one of the two available securities, I'll calculate return and risk for both securities. And these are individual series, mind it. So first of all, I'll create a table like this and note down all these returns. 25 minus 5, 10 and 15 for X, and 14, 8.5, 5.5 and 17 for Y. Then I make a sum total of these two series, and coincidentally sum total, that is summation of X and summation of Y, is same, 45. Now with the help of this summation of X and summation of Y, I can easily calculate X bar and Y bar. X bar is summation of X upon N, 45 divided by 4, 4 years are there. And Y bar is summation of Y upon N, 45 divided by 4. So average return of Bajaj Auto and Tesco are incidentally same, 11.25% per annum. But simply by observation, you see the range of fluctuation of Bajaj Auto. It is fluctuating between -5 and 25. While for Tisco, if you see, the return is fluctuating between 5.5 and 17%. So the range of fluctuation for Bajaj Auto is more than the range of fluctuation of Tisco. Prima facie, you can pass a judgment that Bajaj Auto is more volatile. It is riskier than Tisco. But you want an exact number also. See, this X bar and Y bar, they are not full numbers, they are with decimal point. So if I do X minus X bar, cumbersome calculation I'll have to do. To avoid that, I am calculating standard deviation without me. For that, I need X square and Y square. Like 25 square is 625, minus 5 square is 25, 10 square is 100, 15 square, yeah, 15, X series, I'm talking about X series. 15 square is 225. Summation of X square is 975. Let's do the same thing with Y series. 14 square is 196. 8.5 squared is 72.25. 5.5 squared is 30.25. 289 is the square of 17. Make a sum total 587.5. I'll tell you keystrokes for everything. If you want to make this square calculation, just observe this carefully. Suppose you want to make summation of x square, right? So what should you do? You should type 25 in your calculator and press into n equal to. This will make 25 square. Or you can simply press, rather than pressing equal to, you press m plus into n m plus. Different calculators function in different manner. If 25 into m plus you do, and it appears 625 on the screen, that's fantastic. If it doesn't appear, then 25 into equal to and then m plus, that will give you 625. The next thing to do is minus 5 into m plus, 10 into m plus, 15 into m plus, and MRC. So you will get not only these numbers 625, 25, 100 and 225, but also by recalling the memory, you'll get a sum total, which is actually 975. If you wish, you can pause and note down this calculator short keystrokes. Okay, once you have done this, the next thing is to calculate standard deviation. Standard deviation of x is equal to summation of x square upon n. Summation of x square is 975. Divided by n is 4. Minus summation of x upon n, that is 45 upon 4 squared. Do solve it and you'll get it equal to 10.83%. Do solve it and you'll get the calculator keystrokes for the same are very simple. 45 divided by 4 into equal to m minus. So this way you have solved this portion and kept it in memory. Then 975 divided by 4 m plus. Then you recall the memory and press under root. So 45 divided by 4 into equal to m minus. 975 divided by 4. Don't do into m plus, simply do m plus because you don't want to square it. And automatically these items will be deducted in memory. And then you can simply do under root and you will get 10.83. You must be thinking why this plus minus sign is there. Now that's the rule. Plus 2 square is 4 and minus 2 square is also 4. Square of plus 2 is plus 4. Square of minus 2 is also plus 4. Or I can say under root of 4 is equal to plus 2 or minus 2. So when I do under root, I get an answer of plus and minus. What is the interpretation of this answer? Interpretation is, you will say, though the share of Bajaj Auto historically has provided a return of 11.25%, but there is no guarantee that in future also every year it will give 11.25%. There may be, some plus minus. Somebody asks you what is return on Bajaj Auto, you say it is 11.25. They say, are you sure that it will give exact 11.25 in future? You say, no, there may be some up or down in the return. There may be some plus minus. How much plus minus? Plus minus 10.83%. No, for the sake of ease, let's call it 10% rather than 10.83%. So return on Bajaj Auto is 11.25 plus minus 10%. If it is plus 10%, 11.25 plus 10 is 21.25. If it is minus 10, then 11.25 minus 10 is 1.25. So the return will fluctuate between 1.25 on the lower end and 21.25 on the higher end if only one standard deviation fluctuation is there. That's the meaning of standard deviation. If somebody asks you that what will you score in CMA final examination, you say I'll score 60% mark. Are you sure? No, no, I'm not sure. Maybe plus minus 5%. So the range is 55 to 65. That's still safe, 55 to 65. It means you're sure going to pass the examination. But if you ask me, suppose I am also a CMA final student, and you say, Tarun, how much do you expect to score after examination, but before result you're asking me? I say 60%. Are you sure? No, no, plus minus 20% may happen. If plus 20% happens, it will become 80%. I'll have all India rank. But if minus 20% happens, it will be 40% marks, and I'll definitely fail the exam. This is how the risk is measured and used. Okay, guys. Now let's do the same calculation for Y series, that is DISCO. So summation of Y square is 5d7.5 divided by n minus summation of Y 45 divided by n whole square. Under root, use same keystrokes. Put this in minus memory, put this in plus memory, recall, under root, plus minus 4.51%. Right? Now, simply by observation, you can choose one of the two securities. Question is asking you to choose one of the two securities. Which one to be purchased? Both securities are providing same return. That's 11.25. If you have to choose one of the two securities, if their returns are same, choose the security with lower standard deviation, lower risk. Obviously, if returns are same, you should choose a security with lower risk. So, what if the two securities have equal risk? Then choose the security with higher return. If two securities have equal risk, then choose the security with higher return. So what if the two securities have different risk and return? Neither their return is same nor their risk is same. Okay, in that case, you can calculate risk per unit of return, that is coefficient of variation. I repeat, if returns are same, choose the security with lower risk. If risk is same, choose the security with higher return. If both return and risk are different, then use coefficient of variation named as CV. This is risk per unit of return. This is risk per unit of return. And the formula for CV looks like this. It is sigma upon x bar, standard deviation upon mean. For X security, it is 10.83, 10.83 standard deviation divided by 11.25. That is 0.96. What does that mean? That means for each rupee of return, 96 paise of risk is to be taken. For 1 rupee return, 96 paisas risk will have to be taken. And how do I choose calculate it for Y company? It is sigma upon x bar again, 4.51 upon 11.25. This is 0.40. This means in the DISCO share, for 1 rupee of return, 40 paisa of risk is to be taken. So obviously, the security with lower CV is a better security, because for each unit of return, you have to take lower risk comparatively, right? So choose the security with lower CV. Okay, right. Let's have one more question quickly. You have estimated the following probability distribution of expected future return for stock X and Y. Not X and Y, for stock X. For stock X. These are forecasted return. If probability is return, it's not history. What is the probability of your clearing CMA intermediate examination? Sir, there is no probability. I have cleared it already. What is the probability of your clearing both groups of CMA final examination with all India rank in first attempt? Now, this is an uncertain event and you can assign it a probability. If probability is there, it means we are talking about future. We are talking about something which has not yet happened. So you forecasted return on security X on stock X under different scenarios, and you forecasted the return to be -10, +10, +15, +20, +40% with a probability of 0.1, 0.2, 0.4, 0.2, 0.1. What is the expected return for X? What is standard deviation for X? If the stock Y has a return of 10% and risk of 4.94, which stock would you prefer and why? So, in the previous example, we have seen about the historical data handling. Now, let's check it about the forecasted data handling. So, first I note down the probability and return on X. Return is 10, -10, +10, 15, 20, and 40. Probability is 0.1, 0.2, 0.4, 0.2, 0.1. So to calculate mean, first I do X multiplied by P. Observe it, -10 into 0.1 is -1, 10 into 0.2 is 2, 15 into 0.4 is 6, 20 into 0.2 is 4, 40 into 0.1 is 4, make a sum total. This itself is X bar. Do you know that? Because the formula for X bar is summation of Px. Formula for X bar. Just a minute. This is formula for X bar is summation of Px. So mean of this series is 15%. Though the return is expected to fluctuate between -10% and +40%, but on an average, this stock is expected to provide a return of 15%. Now, we can calculate standard deviation without mean. For that, we need to do X square multiplied by P. 10 square is 100 into 0.1 is actually 10. Again, 10 square is 100 into 0.2 is actually 20. 15 square is 225 into 0.4 is 90. 400 into 0.2 is 80. And 40 square is 1600 into 0.1 is 160. Keystrokes can be really very simple, like 10 into equal to into 0.2 m plus. What do you do? Suppose you start here, 10 into equal to, that will be 10 square, into 0.2 m plus, so it will be multiplied and stored in the memory. So keep storing in the memory rest of the items, and then you do MRC, and you'll get it equal to 360. Now use this formula. X square P summation minus XP summation squared. X square P is 360. XP is 15, so 15 squared. 360 minus 225 under root, this will give you 11.62. Return is 15, my dear friends, and risk is 11.62. So 11.62 divided by, typing error, divided by 15. This will give you CV, which is 0.77. So for each rupee of return, you'll have to take a risk of 77 paisa. One more security is given in the question, which says that its return is 10 and risk is 4.94. So definitely here also I'll have to calculate CV because neither the return of the two securities is same nor the risk is same. So 4.94 is standard deviation, 10 is the mean, CV is 0.494. So here risk per unit of return is 49 paisa. Here risk per unit of return is 77 paisa. So your stock X is riskier than stock Y. That's why my decision will be we will prefer to invest in stock Y. Okay, that's it for this session. See you again in the next session. Till then, bye bye. Thank you.